This interview is disseminated on behalf of Xtra-Gold, symbol XTGRF in the States, XTG in Canada. And my name is John Feneck, your host from the Feneck Commodities Report. And with me today is my podcast partner, Don Durrett, founder of goldstockdata.com. Don, how are you?
Great, John. Looking forward to another show.
Yeah, we've got an interesting one today. We interviewed James at $1.50 US back in the summer of last year. And the stock has done extremely well. I think it topped out around 240, 250 a share in the US, and has consolidated a bit recently, but we'll hear from him in about 5 to 7 minutes. First, Don, I just wanted to start off with some names. You and I were talking off camera about how some stocks have a lot of potential, but they're not realizing that potential right now, given silver or gold's ascent. And that frustrates a lot of our followers and investors. But I think people need to see the long game. I know you do. A lot of investors don't have that longer term time horizon. So I'm going to bring up a couple and then you can comment on them. So the first one is Silver 47. We mentioned that recently at 59 cents. It's trading at 54 cents today. The ticker is AAGAF in the States, AGA in Canada. It's mind-boggling because when you and I sat down with them in September, they were at Beaver Creek, they were 59.60 cents. They ran to $1.01 on huge volume. And then now they're lower than September's price. If anyone wants to look up the price of silver in September, it was very low compared to where it is now. So with 250 million plus ounces of silver equivalent in three great US states, like how is this happening? Right? I mean, that's question number one, because I think a lot of people have that question. I get a lot of feedback from clients and from people that watch our show. Another one that you brought up recently was Guanajuato, GSVRF in the States and GSVR in Canada. That ran past 80 cents and is trading now at 45 cents as we record this. Another one that's literally, down 50% from the peak. This isn't like a 20% correction from the peak. This is a 50% correction in both cases. And then lastly, I'll try to think of a gold stock here. Let's see which one. Yeah, I think I'd like to talk about Next Gold. We mentioned it briefly last time, but this stock seems to have a lot going for it and is kind of caught in that development stage right now where they can really develop either of the two assets in Canada. But when they have 7 million ounces of gold, I mean, this thing's trading at $1.30 right now, and really broke out of a nice base last year. So that one is NXGCF in the States, NEXG in Canada. Can you give us your thoughts on those three?
Yeah, well, the one thing that I've recognized, a couple of things. One is that sentiment remains very, very weak. I mean, if you look at the earnings that these companies are coming out with, and if you look at the one thing that I've been focusing on is the current free cash flow run rate. In other words, what they're currently generating going forward. So if the price of gold stays at 5,000, how much free cash flow will they have, this quarter and for this year? And these companies have been reporting extremely high free cash flows. So we're seeing margins right now, $2,000 to $2,500. And next quarter they're going to be higher. Some of them are going to have $3,000 margins. And so if you look at them, like if you're a 1 million ounce producer right now, your free cash flow is probably at least $1 billion with $2,000, and it could be as much as 3 billion. So it's 2 to 3 billion. And very few of these companies have that much debt on their balance sheet. So they're cleaning up their balance sheet. So if you're a 100,000 ounce producer, you're producing right now 200 million, somewhere between 200 and 300 million in free cash flow. So that's a kind of a small producer. So if you put a 5 multiple on that, you get $1 billion, which is kind of what we saw in 2011. We saw 100,000 ounce producers worth $1 billion. Though we're not seeing those valuations. So those are what they should be valued at, and we're not seeing it. We're seeing these companies getting valued. We did Daenerys yesterday. They're valued like, under two, and all these companies in South America and in West Africa are getting, valued somewhere, two, three, four, somewhere in there. And then the high quality companies are getting valued at 6, 7, 8. The best of the best, Agnico is at 11. So we're seeing these really low valuations for quality producers are generating free cash flow. So the sentiment is really, really weak. So development plays, they come later in the story. Development and exploration come later in the cycle. And so those companies are not getting, they're not going to get any love either. So I can see why silver 47, silver went to 120, now it's down to 75, somewhere in there. And then you had a lot of momentum plays. Traders tend to dominate. So traders, they're trying to make money quarter to quarter. And the second that the Momo comes off, they get out of the trade and they just see you later. They just wait for the Momo to come back. So you have that short-term focus, and then lack of sentiment. It's going to beat up a lot of these stocks. We saw a lot of high flyers. Guanajuato is a good example. High flyers get completely beat up. Guanajuato and Santa Cruz have been completely beat up because they were high flyers. They took off, and now. But if silver goes back to 100, those stocks will come roaring back. Now, will they developers and explorers? Maybe not as fast. Those are cycle 2 and cycle 3 stocks. Cycle 2 is when we go to a high valuation. Cycle 3 is kind of a mania. And so, I mean, today we're going to talk with Xtra-Gold, which is an exploration play. That stock is more of a cycle 2, cycle 3 story, when it's kind of a rising tide story. So if we look at valuations of these companies, as these high quality producers get valued correctly, normally, then they'll bring all the producers with them, and then they'll start to go higher after that. They'll go to that next phase, and then that's when the developers and the explorers come along for the ride. So I've always said this is kind of a 3-wave, 3-cycle thing, in a bull market. It doesn't happen all at once. You got to be patient.
Okay. So next gold, I would imagine that's in that same phase 2, phase 3 category. Yeah.
Absolutely. It's amazing. People will not give Next Gold any value for Goliath. They pretend that they don't even own Goliath. This is an opportunity. I always look for these companies that have projects that you get for free. Like we talked to Daenerys yesterday. You get Lomero for free. And
Right.
it's we talked to Paramount Gold Nevada. You get Sleeper for free. So I'm always
Right.
looking. Aya, you get Boumadine for free. I'm always looking for
Yeah.
these projects, these secondary projects that are getting zero value. And Next Gold is a perfect example. They have this Goliath project that's 250 million, development play capex. It's going to produce 100,000 ounces. It's worth 1.5 to 2 billion dollars, and they're getting zero for it. So I love those opportunities. I love to buy these companies that have these secondary projects. Another way you can think of secondary is a producer is going to expand an existing project, or they're going to build a second project, like Discovery Silver. You're getting zero value for Cordero. It's this that right, and then Avino, you're getting very, very little value for their upside on expanding, their project. So
Right.
look, this is what you look for. Like Hecla and Core, they really don't have any secondary projects. They're basically just going to go up based on silver prices. But where you get your leverage is in these companies that have a secondary, like Endeavor Silver. They have Pitarrilla that they're developing. So I always look for these. First Majestic, they have Jarrett Canyon. I always look for those secondary projects that are going to push these stocks higher.
Yeah, that's a good point. We just met with Denarius, DNRSF in the States, and DMET. Don is referencing their Spanish project, which gets zero credit in the valuation. And then Paramount Gold, same thing, PZG. Rachel's Sleeper project in Nevada is a beast. I mean, there's 40,000 acres there, 3 million ounces of gold. It's just sitting there. I mean, it's just, and the stock is at $2.13 as we record this on just their Oregon project moving forward, which looks very, very promising. So, at what point can that company in a hot gold market say, you know what, we're just going to start drilling sleeper? I think that could happen as early as Q4 this year, maybe Q1 of next year when they come around to it. They've held it this long. I don't see them disposing of it at rock bottom prices, but we'll see how that plays out. Lastly, I just wanted to mention two stocks that put out updates that you own and I own. Rua Gold we had on last year in the fall. Interesting story there. NZAUF in the States and RUA in Canada. They basically said we have two projects, like you're talking, Don, and our primary project is going to have a 43101, and our backup project is going to have a PEA or vice versa. I can't remember, but this is all happening in the next couple of months. So when you finally get to that stage where you're putting out these kind of advanced reports, it gets exciting because up to this point, it's a gold and antimony explorer, right? But now you're going to put some numbers behind these things, and I think you're going to see a re-rating in that stock. And then
Yeah,
Triumph Gold finally put out some news. We just talked about them a few days ago. TIGCF in the States and TIG in Canada. They basically gave a game plan for what they're planning to do for this year, which I think more companies should be doing, right? Like that's free. It doesn't take much as a CEO to say, hey, here's what we're doing over the next 12 months. If you're not coming out with drill results or you're not coming out with development results, like that's a great way to stay in front of shareholders.
I I just want to mention about we were talking about how companies have these secondary projects that get zero value. You mentioned Paramount Gold Nevada. This is a really good example. So Grassy Mountain, which is kind of a really close to being fully permitted, they'll have no problem financing that project. 50,000 ounce producer, starting off with 8 years, there's probably going to be 12 years. And so valued at 200 million. The Sleeper project has 3 million ounces of gold. So at 3 million ounces of gold, once this market, if we're right that this is a bull market and it's going to have legs, and I think it will, and it lasts at least 2 more years, at a certain point, gold in the ground is going to be worth something.
Right.
So if you look at Sleeper, I firmly believe that it's only a matter of time before an economic project in Nevada is worth $100 an ounce in the ground.
Yeah.
It's just a matter of how long it's going to take. I mean, that's where it's going. I think minimum. So Sleeper's got 3 million. So that's $300 million of value that Paramount's sitting on. They're getting no credit for. It's like that's the kind of insanity that we're seeing here today. But that's one example. There's several, but those are the kind of opportunities that exist out there.
Yeah. That's a great example. And uh, we met with Rachel for dinner 3 years ago, almost to the day, and we were telling her, "Hey, hold Sleeper," and she did a great job of doing that. I'm sure she's been circled by a lot of people for a 3 million ounce gold deposit in Nevada, like the number one jurisdiction globally, right? Like she's done a really good job of holding on to that for shareholders, and at the same time, not blowing up the share structure. She's at under 90 million shares out total, fully diluted. That's an accomplishment. So yeah, let's move on and leave it there, Don. We wanted to interview James Longshore today, who is CEO of Xtra-Gold, which is XTGRF in the States and XTG in Canada. Hey, James, how are you?
Thanks for asking me to come back. Nice to do an update.
Yeah,
Yeah,
not a problem.
thanks for coming back, James.
Thank you.
Yeah, I really liked your story after we interviewed you. We bought some and have just been holding it on the way up. But interestingly, like your stock just has a really nice steady ascent to it, going back months. Like it doesn't really have a lot of gyration in the share price, but it's trending higher with gold, which is great. So would you mind giving us maybe an 8-minute overview of the story and then we'll ask some questions?
Sure. So number one, thanks for having me back. And we've been working hard since our last interview 6 months ago. We're in a real bull market now for the physical commodity. So like you guys talk, it's only a matter of time before some of these junior explorers like us get discovered. When I talk to you, our first resource footprint area, we were at 1.2 million ounces, NI 43-101 certified. And we just did a bunch drilling about 10,000 more meters. And our internal modeling shows we've added another 300,000 ounces right at surface, adjacent to the resource. We're hoping we can get that first structure up to 2 million. It's from surface down to about 250 meters. We're just trying to prove up the open pit. As soon as we get to 2 million ounces, any major in our area would like to acquire us because there's been no multi-million ounce discoveries in the last 15 years. We're it. And we've identified 6 adjacent structures to this open pit structure. We've identified the first gold footprint just below us. When I say just below us, I'm talking like 500 meters below us, up to 3 kilometers away. So this thing, I think, will be I'll be shocked it's not a 5 million ounce deposit. We're going to drill some of those high grade structures. If we can hit one of those, we and show what created this gold all at surface. Xtra-Gold has a chance to be a billion-dollar valuation company, and that's at $3,000 gold price. So I like to be conservative. I founded the company in 2003, so my modeling, I'm using $3,000 gold. Some other exciting things we've done, we mentioned last time, we've permitted our 5 mining leases. So there's no permitting risk. They've already been permitted to mine. We own all our own drill rigs. We own 4 right now. So we're finding an ounce of gold for about $5 an ounce in the ground. And at 3,000 gold, that can sell for 150 an ounce in the ground. Quite a bit more than Nevada because I think the grade and also it's all very easily open pittable and permitted. So we own our own rigs. We've done an issuer bid. We've canceled a lot of shares. We've done no major financing since our IPO in 2010. And we have a community mining project not near where we're finding the hard rock, but we have an alluvial footprint of gold. We've mined that with the locals, and we work on a revenue sharing program that funds us about 5 to 6 million of free cash flow, which we've used to finance all the drilling on our hard rock. So very unique for a gold exploration company. And I think that's why we've partaken in this upward movement with gold, and we will continue to. And we are obviously significantly discounted. We're only trading at 100 million market cap. And if we can take this thing to, 5 million ounces, you're looking at a 1,000% return easily. You're looking at potential 500 million, sorry, 500 million market cap easy. So that's a 5x. And if gold stays here, you could be looking at double that, which would take you to 10x. So last cycle in Ghana, we've got more mines per square kilometer than anywhere in the world, they say. We have 8 major producers. And last cycle, we saw gold exploration companies being sold to over $200 an ounce in the ground, and that was at $1,500 gold. So if gold can stay at 5,000, like Don says, we can look at some really high valuations because these things are permitted and shovel ready. So that gives you a brief overview. So I think we're quite unique compared to our peers. And we've run it, like a private company. And the 3 major shareholders own 18 million shares of the 47 million. So we own a big percentage of the company. So we're fully invested with our shareholders. So I think that gives you a little update from the last time.
Oh, that's great. Thanks, James. So let's start with what you just said first. 18 million shares of 47 million. Is that fully diluted?
That's fully diluted. You'd be looking with, so that's outstanding. So fully diluted, it
Okay.
would be 51 million. Most of those are employee options. All our employees have been with us since 2006. So we
Okay.
haven't had one management person leave since 2006. So they're fully vested. No one's ever exercised any options. So there's about 3.5 million options for management. Yeah. And most of
Okay.
them are geologists out in the field.
Great. And then my other question would be just talk to us about the other players in Ghana. You said there's 8 producers. Like, what are some of their names?
Well, the ones that you'd recognize, the big ones are Newmont, the largest producer in the world. They do 1 million ounces a year of gold production in Ghana with 2 mines. Then there's Gold Fields. They do about 1 million ounces between 2 mines. And Anglo Ashanti, about 500,000 ounces per annum on 2 mines. And then the closest mine to us was run by Newmont. It was called the Achim mine, and that was bought in July, coincidentally, 2025 for $1 billion cash. And that only had
Okay.
a resource of 2.5 million ounces. And that's 30 kilometers from us. So that would be the closest mine to us. So as we develop, that would be strategically, if I was them, I would be seriously considering this asset as our resource grows. You might be able to truck the ore. I know Newmont had a conceptual haul road when we used to talk to them quite a bit. We had quite a few CAs with them to do. They looked at developing our project, but we never could really come to a fair, a mutually agreed upon price. Yeah.
Yeah. Well, it's good that you didn't.
Yeah. So there's four. And those talks happened in like 215, 216, 217, 18. The gold price is pretty low, right?
Exactly.
So it's good that we didn't do a deal because obviously there's a lot more for shareholders on the table now that we're growing the resource and we're in the gold market.
Absolutely. Well, thank you. And Don, I'll turn it over to you.
Hey, Jim, my first question is recently Ghana, they changed a little bit of their tax structure. Can you talk a little bit about that?
Well, they haven't changed much yet. They reduced the VAT. So VAT is a sales tax, like a state sales tax. So value added tax, most European countries, it was 20, it worked out to like all in probably 25%. They've reduced it to 20 and they eliminated it for explorers. So they said any exploration cost is going to zero. The government's been talking about that for a while to implement more exploration in the country. But besides that tax, they've talked about increasing the royalties in the news. Most of the majors are paying 3. We pay 5 right now. They're talking about increasing those, but that process would take a while. It would have to go through Parliament. The president would have to be behind it. Something like that. If they rushed it, would take at least 12 months to go through Parliament. But so there's some rhetoric on them changing the royalty rate, but there's been no changes. And you have to remember that Ghana's main producer for US dollars for export revenue is 35% gold. So they need to be careful if they're going to change the tax code. They don't want to make it, in my opinion, non-competitive with worldwide standards. But it's not uncommon to see a lot of rhetoric. So far, rhetoric, I'm not saying they won't make some changes upward, but right now there has been no implementation.
Right. Wasn't it the president, though, that came out and said he wanted to raise it to 8%?
It wasn't the president, it was the acting CEO of Minerals Commission, which they're in charge of the resource sector. The talk was actually, I think, 9%. But most people I talked to say that wouldn't fly because it would be too onerous. So, like I said, we're paying 5. Most of the majors are paying 3. I suspect they could look at increasing it a bit, but I'm not. I think 9% would be overly onerous, right?
Okay. The margins have absolutely exploded. You said that it cost you $5, right, which is crazy cheap. I mean, the average is about 50 to 75 to
Right,
find gold. It's costing you $5 to find gold. And you
right,
mentioned, you could get it 150. The margins, that's what it used to be.
right,
That's what you're talking old numbers. Yeah, that's when gold was at $3,000 and you're using 3,000. I think you should bump that up to at least 3,500, which would still be conservative. But if once you get to $5,000 gold where we're at today,
right,
most of these companies, have $1,800 ASICs, so their margins are around 2,500, and some of them have even lower than that. I've seen a lot of companies currently, the last quarter, we're at 2,500, and then this quarter, we're seeing a lot of companies that are above $2,500 margins. So if
right,
if margins stay, I think margins are going to stay above 1,500, and probably they could go north of 3,000. So we could use a range, 1,500 to 3,000. That's how much that's net. That's when I say margins, I'm talking about free cash flow margins.
right.
So
No,
it costs you $5 to find it and you're getting 2,000 back. At that point, I think companies are willing to pay $200 an ounce in the ground if those margins stick, for a while. Yeah, so I think that's kind of you're basically finding it for 5 and you can sell it for 2. So the return on your drill bit is pretty amazing right now.
right,
Um, so yeah, it's going to be fun to watch. I think your story is fairly well understood. You have like 50,000 hectares or 50,000 acres. I know it's a pretty big property. What is it?
55,000 acres, which equates to
Yeah.
the US viewers 90 miles squared. And we've only
Right.
drilled 2 kilometers of the property.
Right.
Obviously, so we've only tackled 2%, but our goal is to tackle those other 6 structures below the open pit potential. So, I mean, like I said, if we hit one of those, you could be looking at $1 billion.
So the smart thing to do would be to basically JV or sell your first discovery and then take that money and drill the rest of the property, right?
Yep,
Piecemeal it out. Is that kind
correct.
of the plan?
That would be the smartest thing to do if you have we're expert explorers. We know more about exploration. We've been doing it there for 20 years. So we've actually mapped, soil sampled, done all the magnetic surveys over the whole belt. So we have a competitive advantage. So yes, the smart thing would be we have 5 properties, would be to sell the one we grow the resource on, and then maybe go to work on the other ones if it's not a hostile situation. The parts are worth way more than the whole, right? So you
Yeah.
could structure it if you find the first one. So our goal here is our shareholders have been in it a long time. Our goal here is to accelerate the drilling, which we're doing. Hopefully get in to show this is going well over 2 million. And then, drill as hard as we can over the next 12 to 18 months. And then if we have a fair buyer for the resource and it's open-ended going to 5, we don't need to find every
So,
ounce.
right. So I would think that instead of selling it, I would think you would keep a chunk of it for free cash flow to fund the rest of your properties, right?
Well, coincidentally, the community mining project's not even on. There's no revenue coming off the hard rock development. It's coming off the other properties that we haven't drilled for the hard rock. So the alluvial footprint is mainly on the other properties. So we would keep that and keep our community mining project and hopefully find a partner. And like I said, the logical one is Xinjiang. We'd probably go with them once we get to a couple million ounces to see if they want to, look at doing a deal because they
Right.
have that mine they can double the capacity. Newmont was doing 400,000 ounces and they're around, 250,000 ounces, 250.
Well, right. So if you kept 25%, even 20%,
Right.
at $2,000 margins, that would be 200 million in free cash flow. If you kept 25%, it would be 50 million a year. A year. So you might, I mean, if you just kept 20%, that's $40 million a year. That's a lot of cash to for drilling. You can go buy some more properties.
Right. So, I mean, I think this is a unique opportunity because it's an advanced stage exploration. It's permitted. We're one of the lowest finding cost producers in our industry. Okay. And we've been doing it since 2006. Okay.
Right. So yeah, so you're one of the, usually I don't like the project generator model that well, but in your situation, if you keep 25% of that project, it pretty much it puts you in a very, very strong position to drill out your other 4 structures. It's like you got all this cash. I mean, it's literally too much. You're going to have so much cash, you're not going to know what to do with it. So there's going to be zero dilution. I mean, you're inevitably, if you keep 20 or 25%, inevitably you're going to be buying more property because you're going to have all this cash. You're not going to know what to do with it all because you can't drill that much. You can't drill. That it's too many drillers, too many, right? So it's a good situation to be in.
No, I think we're well suited. And remember, we developed this. I mean, we thought of things like you to create cash flow, like you're thinking, because we went through a 13-year bear market and there was no financing for the project. So we self-finance. We had the opportunity to self-finance there, but very few explorers could self-finance. And so we're a leader in an area. We're the only driller. We're the only one that's done hard rock drilling. There'll be multiple gold deposits found there. It's just a matter of, does someone take us out hostilely eventually? Because we do publicly trade. That's always possible, but we'll get a good premium because, we've a lot of the founders have
I
bought them.
I don't think it's possible for anybody to take you out hostile. You're too tightly held. I mean, your insiders own 50% of the company. I don't think a hostile is even possible.
Right. So that means that we can dictate a deal like you're talking about, maybe a
Yeah.
revenue.
I really feel you could do a 20% free carry to production where they would basically literally pay for the capex. I think you'd have multiple people bidding on it once you get to 2 million ounces because it's 1 gram. It's really good grade. Once you get to 2 million ounces, You basically just put a for sale sign out and wait for the phone to ring. The first one in is going to say, "Yeah, we'll do a 20% JV, and we'll give you a free carry until a construction decision. You pay for
Right.
the capex, right?" But then you
Right.
go, "Well, that's a good offer, but I think we can get better. See you later," turn it down.
Yeah. So I think you're right at five. If gold can stay like, in this range, 4,000 to 5,000, we're in a good opportunity. And we've set the company up well to reward the shareholders through share appreciation.
Right.
And like John, you mentioned a lot of there, a lot of my peers, unfortunately, are so fast to go to market and issue capital. And that's one thing that does erode the upside on some of these stocks, which
Absolutely.
we fortunately haven't had to do.
Right.
Um, I think their shareholders can rest assured we're not going to do any anti-dilutive deals that don't make sense.
Yeah, you're one of the few exploration companies that might end up paying dividends.
Yeah, it's possible. So we've got about 20 million from the alluvial mining excess, 20 million US in the till now. We have stocks, bullion, and cash, about half cash, half gold, and half equities. And we don't plan on touching that. We got enough money coming from our community mining project, the 5 to 6 million free cash flow to do all our drilling. We could probably actually accelerate it if we hit another big 1 million ounce shoot. We're kind of hoping
Right.
to hit the high grade stuff. So we have
So
structural.
what are you going to do when you got $40 million coming in every year?
What I'm going to do? Probably send our shareholders a nice big dividend. And I have,
I know, that's what I mean. Your exploration company giving out dividends. That's an
I
irony.
mean, if we're not going to get bought out, we'd have to start dividending it out. The cash. Some of it.
Yeah. Yeah.
Yeah,
Yeah.
I would recommend instead of a special dividend, consider doing something on a regular quarterly basis, like 3%, right? Like that in 2011 and 12 started to really generate more interest from the street in our sector. And I'm seeing that right now, James, in the last 2 weeks with earnings. You
Right.
saw Barrick just raised their div 42%. We had a bunch of names produce earnings overnight, and a lot of them raised their divs. So I think that trend is here to stay.
I agree. And I've seen it in the oil and gas too. Like
Mhm.
seen big dividends from the Canadian oil and gas producers. And you have to remember, if we're going to go to that model, and I'm saying there's an option to. First, we got to show it's the 2 million plus, and then we can start looking at different options. But if we go to a dividend model, it'll be much more than 3% because even if we send out 5%, $5 million, that's a 10% yield with 50 million shares, right? So
Sure.
if you're generating like 25 million, yeah,
I had one final comment, and that is you're in a really good neighborhood. West Africa, I mean, there are so many properties to basically explore, if you will. I
right.
mean, Cody has got a lot of them, right? Senegal's got a lot. And so even Ghana, so you're in a good neighborhood for picking up a couple properties to drill, right?
Absolutely. And but as some of the big geos that came to my property said, your grandkids could drill here. You guys have a whole gold belt open. So
Nice.
we stayed very focused on our gold belt. So we're very strategic, and there's probably 20 million ounces to find. We're just approaching the first 2 million, right?
Nice.
So our goal will probably be to drill that whole belt out, and we're
Nice.
in there. So that's kind of our focus. We're not going to go out. Yeah.
I love the story. This is great. Beautiful, Jim. You got a nice situation going on.
Thank you. And thanks for all your support.
Sure.
Yeah, of course. Thanks a lot, James. We appreciate you coming back on and hope to have you back on later this year again.
Thanks a lot. And anytime, looking forward to it.
So, Don, give us your summary, please.
I'm in a bull market. I want to own producers and developers, but this is one of the better. Last time I was on here, I said this is a really good drill story. I mean, they got lots of cash. They're tightly held. 51 million shares is it. They're not going to dilute. They're set up beautifully for adding ounces in the ground at a very low cost. They're set up beautifully to do a JV deal. I mean, it's just around the corner. to give him even more cash. I mean, and then they have this property that they could drill. He said he could drill it for probably a decade, another decade. So you don't see too many drill stories that are, this solid. Now there are a lot of drill stories that are more exciting because they're higher grade, really, you can add a lot of ounces real fast and you can make, you can rip to $1 billion. This one's going to be kind of a slow and steady drill story. It's kind of a boring story if to some degree. Like a lot of people, they prefer, kind of these rocket ship exploration plays. This isn't a rocket ship exploration play. It's kind of a slow and steady to a billion kind of thing. But it's pretty rock solid. I like it a lot.
Yeah. So when you're saying slow and steady to a billion market cap, they're trading at 100 million market cap at the recording.
Yeah.
So that would imply a 10x return from here. James was talking about a goal of 5 million ounces eventually, right? And as he's closing in on 2 million ounces, you get to that 2 to 3 million ounce range. We both know that those majors are going to start knocking on the door. Those are some big boys in the jurisdiction. And yeah, they see 55,000 acres with 2 to 3 million ounces. They see upside, right? Like a lot of these companies are going to need to uh, fill up their coffers because some of these companies are going to deplete assets quickly, right? In the mid tier and large cap space.
Yeah, so he's getting valued about $100 an ounce right now, which I think is about half off. I think it's going to go to 200. And so he's every ounce that he finds right now, he's getting $100. And I think it's going to go to 200 for every ounce that he finds. And he says it's costing him $5, $5 to $10 to find it. So $5 to $10 to find it, and he's getting 200. So that's a pretty good return. There's your 10x right there.
Yeah, good math. Don, thanks a lot for the time. And this has been a nice recording with Xtra-Gold CEO James Longshore. We'll have the tickers for you guys in the show notes. And please check us out. Our websites, we hardly ever plug this, but Don's is goldstockdata.com and mine is fenneckconsulting.com. I just celebrated my 10-year anniversary. In the mining space, we have a very solid 10-year number and wonderful 3 and 5 year number versus our peers as well. And we offer a lot of different services, Don and I. We're also probably going to do our first webinar here in March in 2 years, where we could, do something for you guys as a gold and silver audience and also answer some questions along with giving you some of our top picks for 2026. So check us out on the web and thanks for listening, everyone. Take care.